Gold is replacing the U.S. 10-year. It's happening right in front of our eyes. And yeah, now the gold price is undeniable for those of us who've been paying attention. What's sad though, Kai, we hit the $3,000 target. The next technical average move on the cup and handle formation is gold at 4,000, which to me is not at all unlikely. It's absolutely certain. Does that mean gold only goes in a straight line? Absolutely not. It typically, once it hits that target, it can retrace on the 200 moving day average, go back, and then launch again much higher. But again, for a long-term investor, that's irrelevant. Of course it's going to go to 4,000. It's going to go much higher than 4,000. I'm absolutely convinced. Remember it was at 1,600. I said it's going to double in the next 5 years, and it did. And it wasn't because I was some guru or some technical or fundamental psychic. It was just the gold rises because paper money is falling.
Gold is increasingly acting as a replacement for the U.S. 10-year Treasury bond, with its recent price surge confirming this shift. Analysts suggest gold could reach $4,000 based on a technical cup and handle pattern, though it may experience short-term pullbacks. The long-term outlook remains bullish, driven not by guesswork, but by the simple reality that gold tends to rise as the value of paper money declines. Matthew Piepenburg, a macroeconomic strategist and financial author known for his critical analysis of global markets, highlights that the U.S. is facing a severe debt crisis that no one can solve. The Federal Reserve's attempt to fight inflation through rate hikes failed, leading to a banking crisis and market turmoil. The rising bond yields increased the cost of debt, making it unsustainable for the U.S. government. Even Trump's tariff strategies were thwarted by a lack of interest in U.S. Treasuries, signaling a deeper problem. The only way out now is more debt, printed as money, which is highly inflationary. The bond market's volatility is a constant reminder that the government and the public are trapped in a cycle where attempts to fix the debt worsen the situation. Let's jump into the video for more details. If you like what you see, please thumbs up and subscribe to our channel to stay updated with our latest content.
Look, I mean, we're at 85 degrees and the evidence is clear that we're trapped. Again, look at two simple examples of how trapped we are, that there is no easy way out, that there's no solution, there's no easy solution. Powell's war on inflation, which he clearly lost. Again, not even getting into how that we measure inflation is an open lie in the U.S. The CPI scale is an open lie. We're really at about 13%, using the same scale that Volcker used in the 1980s. So U.S. inflation is much higher than it was. Powell could not beat inflation. He tried in 22 and 23 to raise rates to fight inflation. And all he did was create a banking crisis and a market crisis. Because when he raised rates, the bond market tanked. When the bond market tanked, bond yields went up. And since bond yields are the cost of debt, we hit what was called fiscal dominance, that by trying to fight inflation by raising rates, he actually made Uncle Sam's bar tab more expensive. So he had to pivot to lower rates. He couldn't even win the war on inflation. That's how out of ammunition the Fed really is. It's completely broken. When Trump announced Liberation Day on April 2nd, what no one talked about, what the headlines didn't discuss, just like Powell was trapped by debt in 2022 and 2023 in the failed war against inflation, the absolute lie that was transitory and fixable, it isn't. Well, when Trump announced Liberation Day, what didn't make the headlines, when he announced all these harsh tariffs and he changed his mind within hours, there was a reversal of that. In the meantime, the markets lost 10 trillion in market cap just on the announcement, and then got 4 trillion back when Trump kind of became more dovish. But the real reason Trump couldn't really push those tariffs wasn't the art of the deal or pushing really hard and then pulling back. The reason Trump had to pull back, although there's still 10% tariffs, and China certainly got hit even harder, but the reason Trump, quote unquote, pulled back wasn't because of the art of the deal or a negotiation tactic or strong arming, carry a big stick, talk softly. The reason Trump pulled back is what no one saw, is the next day after Liberation Day at the Treasury auctions, no one showed up. It was crickets. No one was buying U.S. Treasuries, that once sacred cow, that once essential safe haven when markets are volatile. In fact, the U.S. Treasuries went down in price and yields went up on Liberation Day. Gold did not go down very far. In fact, it went up. In other words, what was supposed to happen didn't happen. And why Trump and Bessent had to pivot and be a little more dovish on the tariffs, at least for 90 days, is because there was no one showing up at the Treasury auctions, no one buying U.S. Treasuries. In fact, there was a dumping of U.S. Treasuries during that April crisis, that peak moment of volatility. And again, so what I'm saying is, just like Powell couldn't fight inflation because his bond market wouldn't let him, Trump can't really exercise or prosecute a trade war without creating tremendous volatility in the bond market, because the bond market is everything and no one wants to talk about it. But the bond market is everything. And yields started to spike. And when Uncle Sam sees rising yields, that makes it impossible for him to pay his own bar tab. So the Fed and the White House have to keep those yields down. And since no one's buying them naturally, and since GDP isn't high enough and tax receipts can't pay for them, that just means at some point we're going to have to print more money. I mean, I think, what was it? Bernanke printed in 4 years. What was the number? I mean, it was like, Bernanke, I think it was in 4 years, 2.5 trillion, and then Powell in 18 months, 5 trillion. And now the Congressional Budget Office is thinking for us to keep yields controlled, we're probably looking at 10 trillion more. So the point is, our only solution to a debt crisis is more debt, paid for with literally synthetic money created out of nowhere, which is highly inflationary. And so whether we're trying to fight a war on inflation or puff our chest with a tariff war, every time we try to do anything disruptive, it sends the bond markets into a tizzy and yields go up. And I'll just end with this. Rising yields, so everyone knows this, are shark fins to a debt-soaked nation. It's shark fins because those rising yields, it's like blood in the water, and you see those shark fins coming. Uncle Sam, corporate America, and the man on the street cannot afford rising yields. So we have to always pull back or give up because our debt levels are so high that anything we do to try and fix them naturally just causes yields to spike and the cost of debt to get higher. So we're damned if we do, damned if we don't. That's why I said Papa Smurf, Mother Teresa, Albert Einstein, no one's going to solve this debt crisis overnight. And we're finding all kinds of ways to distract ourselves from that. But that's the bottom line.
Matthew Piepenburg reveals that the U.S. faces a dire debt crisis with overspending on military, entitlements, and public debt. Despite efforts to cut aid and spending, these measures are insignificant compared to the massive debt burden. Trump's tariff strategy and attempts to repatriate labor have caused market volatility. Still, the real issue lies in rising bond yields, which make it impossible for the U.S. to manage its debt. The U.S. government's reliance on printing more money is inflationary, and the bond market's instability threatens the entire financial system. Gold is emerging as the new haven, gaining traction globally as countries move away from the US dollar and treasuries. Central banks and nations increasingly recognize gold as a more reliable store of value, signaling the decline of the US dollar's dominance. Now, let's get back to the interview.
Corruption and the overspending of US aid, or the need by Doge to cut $2 trillion off of our spending by the anniversary of our country in 2 years. Optically and substantively, I'm all in favor of cutting $2 trillion in spending or cutting the waste at U.S. aid. But relative to our military budget and relative to our entitlements and relative to our public debt, which is really $37 trillion, and we're paying more than $1 trillion on interest on our U.S. Treasuries every year. It's higher than our military spending, which is about $900 billion, and our unfunded liabilities. So yes, these are wonderfully good endeavors at Doge and USAID, but they're nothing. They're a guppy solution to a whale of a much bigger debt problem. And the other desperate measures, like a strategic Bitcoin reserve, which is an El Salvador model of speculation to pay down debt, is a third world solution to a first world problem. That's desperate. And the tariffs themselves, it's really not about protecting U.S. industry. It's about forced repatriation of American labor from the east side of China. And I understand the optics of that. I actually am all in favor of bringing the P back in the GDP in the U.S., bringing productivity, bringing labor back, bringing manufacturing back to the U.S. But that's the real intent, one of the main intents behind these tariffs. But that's expensive. That takes more than a couple of years. It takes more than 4 years. And you can't do that without deflation, inflation cycles that are brutal to the man on the street. And that's where the risk of, again, going back to your point, social unrest, more autocracy, more controls, and more lies to replace math, and hopefully not more military distractions to keep the man on the street from being tricked out of this. I've always said the middle class in America is the first to be drafted and the first to be shafted. Whenever there's a military crisis, it's always the working poor, the middle class or lower middle class, who either volunteer or go to war because they have less options. So they're the fodder. And then when markets mean revert and crash, and there's crushing 401k and pension losses, the quote-unquote RIA industrial complex consensus think wealth advisors just blame it on extraneous events. They're not protecting wealth. They're just long a Fed-supported market. And when those markets mean revert and crash, it's the middle class and the pensioners who get shafted. And if there's a war, it's the middle class who get drafted. So, that's why it's really important to talk about market risk and bond risk and precious metal support, even for the middle class, because they have to protect themselves in ways their governments won't. The governments won't protect them from inflation by having a sound money policy or understanding gold better. And so you have to do that yourself. Again, that shouldn't be a gold bug apology or gold bug book selling. It should be common sense, because throughout history, gold has always held its value, stored its value better. It's always been the life raft when the Titanic sinks. And as we're seeing with the BRICS and other nations, as we're seeing with the COMEX flows and the outflows of the COMEX, as we're seeing with the oil trade and the slow waning of the petrodollar, as we're seeing with repatriation of gold into the zip codes of these countries, gold is emerging as that new life raft as opposed to the U.S. Treasury, that other tier one asset, the BIS. Gold is clearly the new direction. And now as that Titanic is sinking, the world is catching on. The U.S. dollar and U.S. Treasury isn't what it used to be. And I joked in South Africa, when the Titanic was sinking, a lot of guys were in their tuxedos thinking they were going to go back to the A deck and finish their brandies until they started to see the water really rising. And then it was a controlled panic, get the women and children on the lifeboats. That was very chivalrous. And then it was all panic, every man for himself. And I think what we're seeing now is a slow move out of that Titanic sinking from, okay, now there is rising water, rising debt, things are getting bad. Now let's get those lifeboats. The BRICS, the evidence is clear from the COMEX to the BRICS to the oil trade, even to what we just saw in the Liberation Day tariffs, that gold outshined every other asset. That's the new life raft. And now everyone's scurrying for it. Certainly the whales are, the bigger money is. The retail audience hasn't figured it out yet. It's sad. But now there is a scurrying, every man for himself, every nation for himself. And as you and I were talking before, this is like Kissinger said, to be an enemy of America is dangerous, to be a friend is fatal. And Germany and the EU and other countries that followed and believed in the gold standard before we welched on that in 71, or believed in trading partners with the U.S. until Trump just welched on that in April. America has neither friends nor enemies, just interests, like every country. And we're seeing that very clearly now. And so every country is now either banding together on the BRICS, who don't necessarily trust each other clearly, but they trust gold, and they're net settling in gold. And the BIS has now forewarned us for years that gold is going to replace the U.S. Treasury as a tier one asset. The IMF has told us that whenever we do go to this awful thing called central bank digital currency, for it to have any credibility at all, it has to have some gold coverage in it. So gold is clearly, even the Basel Reg 3s we can discuss, it's signaling that gold is a better store of value than that infinitely worthless asset called the U.S. Treasury, which really doesn't beat inflation and is a declining asset from an issuer that's...
The U.S. is facing an increasingly unsustainable debt crisis, with attempts to combat inflation and manage debt through traditional methods like rate hikes and tariffs falling short. Gold becomes a crucial haven for investors as the dollar weakens and bond yields rise. This shift away from U.S. Treasuries and the dollar reflects growing global distrust in the stability of U.S. financial instruments, with gold gaining prominence as a more reliable store of value. How can the U.S. address its growing debt crisis without further exacerbating inflation? What role do central banks play in the global shift toward gold as a store of value? Share your thoughts in the comments below. We'd love to hear from you. If you found this helpful video, don't forget to give it a thumbs up and subscribe for more content.